Well, there's no doubt about it. When it comes to money and our emotions, it's really hard to keep those two separated. And so today what we want to talk about is how retirees can avoid emotional investing mistakes. And John, today with everything going on in the world, we just tend to feel and see around the office that emotions are higher than they usually are. Not that there's never things to be worried about. There are always things going on around us that can have an impact on our investments and our retirement. But in today's environment, it just feels different. It feels more heightened. And so what we want to try to help share with people today is how can you, if you can't eliminate all of the things happening around us, right? Political environment, wars, interest rates, all the things that tend to get people a little bit hyped up today. If we can't eliminate those from being surrounding us, what can we do to minimize the impact that those things have on our investments and more importantly, our emotional state in making poor investment choices?
I didn't realize there was anything going on around us.
I didn't know anything?
This little thing, the election, little turmoil, emotions about that. Then we got Russia, Ukraine, what's happening in the Middle East. You think about just the last few years, I've had a 100-year pandemic, 40-year high inflation. How much talk has there been about recession? We haven't seen that yet. And so one of the things I think that most people could do is, we're going to talk about, first of all, avoiding panic. One of the ways you do that is sort of tune out the noise. I think everyone's always got an opinion. Very few people have a plan. But the first thing you want to do is you really want to avoid panic. You want to keep your emotions in check. And if you're defining your goals up front and an appropriate time horizon, then sometimes we just have to be reminded why we're in the market, why we're investing to start with. Because guess what? Crisis happens. For anyone that's invested, you've seen crisis in your lifetime. You're going to see more crises. You know, I had a conversation with a client the other day who was really genuinely concerned. And it was almost to the point of him thinking the financial markets were going to collapse and it was like the end of the world. And I said, well, if you really think that's going to happen, I mean, do you really think that's going to happen? He goes, well, no, I don't guess so. And I said, well, why would you waste time really focusing on that, right? Because it really just sucks the life and the joy out of your own personal life and your retirement, certainly. What you want to have is a good plan. So I think the first thing is really defining that time horizon and really understanding who you are as an investor. And that's one of the best ways to avoid panic.
Yeah, I mean, the emotions come into play more commonly when there's fear, right? Not a level of excitement or enjoyment. Like, people don't make emotional decisions, poor emotional investment decisions when things are going really well.
Yeah.
They make poor investment decisions when things aren't going well, and there's a level of fear, something that needs to be identified within them of what's causing me to feel this way. And John, we find more times than not, it's the lack of having a defined plan, right? If we know that things are going to happen in the world and we know that the economy is going to change, there's going to be ups and downs, but if you had a plan that you knew that your income and the enjoyment of your retirement and that all of your needs were going to be covered regardless of what was happening in the world, I think that gives a level of confidence that eliminates the fear that drives these emotional decisions. And what we find is that people don't have clearly defined investment plans.
And, you know, it's interesting to me because when we sit down with people, their story is very similar, right? They may have been a doctor or, maybe they're a dentist or a nurse or a teacher or a police officer or a firefighter, just whatever they were, engineer. But their story is very similar. Hey, I worked 30 years of my life. I saved money. I raised a family. I got them through college. And I delayed gratification to get to this point in my life, or to try and reach a certain point in my life where I can enjoy it. But statistics tell us, Dan, that this isn't, like, you're not alone. And so let's talk about how some of the steps that we do that.
Yeah, I mean, I think when really building a plan, you have to start with income. When we're looking at defining goals and time horizons, it's not just about when I want to retire. That's what a lot of financial advisors base it on. I think that's false. I think we have to build it specifically around how much income are we going to need in retirement. So we define a number, and then we can look at, well, what's our time horizon to needing to draw the income from the investment. So it all starts with really having a clearly defined income plan. What are the income sources we're going to have? Social Security, when should we turn that on? If you have a pension, which options should you consider? And then also, and this is where the fear typically comes in, John, it's not around, Social Security. We get asked all the time, is Social Security going to be around? What's going to happen? Pensions, is there a fear that my company may go out of business? Like those can be in the back of our mind, but they're typically not at the forefront of this whole emotional fear that people have. And so it really comes down to the income gap piece. For almost all the retirees we meet with, people are going to need some amount of money coming off their portfolio or investments. And it's having a plan around that income gap, the money that we're going to have to pull off of our investments. How can we ensure ourselves that that money is going to be there in any kind of market condition? It all starts with being able to identify what that gap is, and then we build the investment portfolio around meeting that specific need for having a more conservative or principal protected portion of our investments that's going to be used more for our income, because we want our income coming off of more conservative or safer type investments. And then that allows us on the portion that we don't need immediately, or even over like the first 5 or 7 or 10 years, that's the money that we can be a little more growth focused on and really do what we should do as an investor and try to take advantage of that. So I'd say defining the income plan and then being able to identify what that risk level should look like.
Yeah, and I would say that we talk about the industry and the whole talks about diversity, and diversity is really important, but our view of diversity is a little bit different than what most people experience. Yeah. Diversity to a lot of firms is just, diversify your portfolio in the market, have some fixed income, small cap, mid cap, large cap, maybe some emerging markets or whatever. And we're not saying that doesn't have its place, but we want diversity of asset class. And one of those is exactly what you're talking about, is having an income plan that, if you think about, the boomers are now retiring about 10,000 a day in America. It's this massive demographic shift. They live in all kinds of fear, but their parents never lived in that fear because they actually had no debt. They had Social Security, they got a cost of living adjustment, and they had a pension. So they didn't worry about income, but really what's driven this fear is pensions have gone away and people don't have that diversified income plan that has some of those things on it that gives you peace of mind, knowing that regardless of what turmoil will come up, because it will come up, whatever happens in the election, there will be turmoil in the next president's administration. There always is, there always will be. It's not a question will you have the turmoil. The question is, how do you want to approach your income in retirement or as you approach retirement? Do you want to have a plan that's actually solid, that you can count on your income? That's what, when we talk about diversity in the market, absolutely, but diversity of asset class to really reduce that fear that so many people experience.
Yeah, I mean, if you think about, if you had a plan that you knew no matter what was happening in the world, that your monthly income need was going to be covered, and that what's happening in the election and wars, that was not going to have an impact on your retirement or your income, I believe that eliminates the fear that a lot of people have. And if you don't have a written income plan that's tangible, that you can bring in and show an advisor, if you don't have a true written income plan, I can almost guarantee that you're going to make an emotional investment choices in your retirement that you end up regretting, or that actually end up harming you by you trying to protect yourself through making these decisions. A lot of times it actually ends up harming them more because they're allowing the emotions to make poor choices over their investments. So if you look at, well, what does that mean, Dan? What do you mean by, these emotional decisions that people make, and when do they typically make them? There is a emotional roller coaster of investing. And I think if you kind of follow along here, everybody's going to agree that, yes, I've experienced this over my investment career, right? So it's, we have a confidence level where everything's going well. We don't have all this noise going on around us. The market's making money. Or we look at our investment statements, they continue to go up every single month. And so we have a confidence level, and we feel very good about what's happening around us. Then we hit this euphoria, right? And it's like, man, we're hitting all-time highs. We're seeing investments hit values that they've never hit before. And it's really when you hit this euphoria stage that a lot of times that happens right before we see the market begin to go down.
Yep. And in fact, people want to believe that they buy low and sell high. But there's this interesting research firm out there called Dalbar. And what they've done for decades, I mean, literally for decades, they've studied investor behavior. And what that proves out decade after decade is that unfortunately, many people don't buy low and sell high. They buy when the market's high, when their neighbors are feeling euphoria because they've made money in the market, and it's the fear of missing out. And so they get in right at the top before there's a correction. It doesn't even have to be a recession. You know, markets correct even at good years, 5%, 10%, 50%, sometimes 20% in a healthy market. You know, pullbacks and corrections in markets are a normal part of a healthy market. You really don't want a market that's going straight up, because markets are not designed to do that. They're actually very orderly. But they get in at that euphoria when they're out with their neighbors mowing their lawns, their neighbors made some money in some position, and then they get a pullback or a correction or a recession, and then they get into that last stage where they feel defeated. They don't have an income plan, so if they're retired, they're having to sell securities while they're down, because you still have light bills when the market's going down, when we have these pullbacks or recessions or whatever. And so then it just becomes this self-fulfilling prophecy, and they repeat it over and over again until they almost give up.
Yeah, and when they hit that kind of defeated state, right? So the market's gone down, we've seen our portfolio decline. It's kind of like a pain threshold, right? Where the market begins to go down a little bit, and it's just kind of like a little scratch where it's like, ooh, that kind of stings, but it's not really painful yet. And then it goes down far enough where it's like a deep cut, to the point where we want to do anything that we can to stop the pain, right? The pain is the loss of portfolio value, and that's when people get desperate and they actually sell into a down market. Market goes down, they're at a point where they go, I can't afford to lose any more money, and so they sell, and they have this immediate feeling of like satisfaction that everything's going to be okay. The problem is, John, I've done this for over 17 years, you for over 25 years. The people that actually sell and get out of the market, almost none of them get back in, because the fear, you know, if the market starts to go back up, even though they're like, well, it's a little bit better out there, they just don't have the confidence that it's going to continue to plummet. Right. Nobody knows when the bottom is. And so this emotional roller coaster of investing is what creates so many negative impacts on a retiree or their retirement plan. And I would go as far as saying, I don't think that anybody out there, if the market goes down, that they have a true belief that their value is going to go to zero. I don't believe that there's many people that go, if the market starts to go down, I'm going to lose everything I have, right? We may feel like we're going to lose everything we have, but the market's been around for over 100 years. We've been through contractions and expansions. That's what a healthy market does, as you mentioned. So if we know the market's going to go up and the market's going to contract a little bit to actually create a foundation for supporting further growth, and it's going to do it again, like this is going to continue to happen. Where the emotions come in is people don't have that defined goal. And again, if you think about it, if you've ever felt that way where you're at a point of maybe selling out completely of the market, if you have this defined income plan, you have the time horizons, you have a diversified portfolio, if you know that your income is going to be covered again, it actually allows you to now take advantage of the market and what it does. So if the market goes down, because we're not relying on that for income, we have no fear or concern that our retirement lifestyle is going to be compromised because of the way we built the plan. Now you can actually look to do some really cool planning in a down market, like Roth conversions or tax planning, or looking to buy into the down market. If the market goes down, if you're a 60-40 investor and the market goes down, and all of a sudden you're a 50-50 investor because your stocks have gone down, rebalance back into 60-40, which allows you to buy into that down market, helping you recover faster, buying additional value. That's smart investing, and I think everybody knows that's the smart thing to do. The problem is that without a plan, they don't have the ability to kind of see through the down market and really use it for the opportunity that's going to be created. I'll say one more thing. Market doesn't go down very often. So that means that if we believe that the down market or buying low is the best opportunity we're going to have, but it only actually happens very rarely, you definitely want to be in a place to take advantage of them when they do happen, because the market goes up more years than it goes down. And so the opportunity for really maximizing value is in the down market, but you're only going to be emotionally stable enough to do that if you have the plan.
Yeah, that's why you really want to work with a financial professional that can walk you through these times, because you're going to have downturns, and that's going to create either opportunities or disadvantages. If you get scared, if you don't have a plan, does that mean you never make adjustments? Of course not. We make adjustments in our portfolio, and a lot of times we're buying risk when we feel like, and no one can time the market. We can't time the market. I don't know anyone that can time the market, but there are some things that you can start to see where a market is bottoming out, and that's where you want to look for opportunities. But you definitely want to stay invested with someone who's looking for those opportunities and looks at the time horizon that you have. So let me give you just a couple of numbers I think is important. This came out from Fidelity, and this is through the end of 2022, but the market has been up through in 23 and 24. So this is a 36-year time period from 1986 to the end of 2022. Mm-hmm. So throughout that period of time, you had the 87 crash. Last quarter of the year was down 37%. You had the tech stock bust where the market was down 3 years in a row, Lehman, the European debt crisis, COVID, 40-year high inflation, all those crises that the market was never going to recover and the world was coming to an end. Here's what Fidelity found in their research. If you had invested $10,000 and stayed invested over that time period, all those turmoils, not acted with emotions, had a good plan, your $10,000 adding no more at the end of 2022, which would be more today, would be worth over $177,000. Yeah. If over that 36-year time period, you just missed the 60 best days, that's essentially less than 2 a year, your $10,000 would have grown to a little over $13,000. Wow. That's how much of a gap there is there. Okay, let's just say you just missed the best 15 days. We're talking about over 36 years. That's like a half a day a year. Your $10,000 would have grown to a little bit below $65,000. So you don't want to be jumping out of the market. You don't want to be acting with emotions. You want to work with a financial advisor that can give you a solid plan and literally walk you through these periods of time and look for opportunities. Well, that is something we would love to talk to you about. If you want to give us a call, if you have questions about any of that, our number is 615-488-3039. We'd love to sit down and be able to talk about your situation and what a plan could look like. Thanks for listening and watching. We really appreciate it. Click subscribe below, and we'll talk to you soon.